All right, we are recording. Give me just a moment to cut my background music off. There we go. All right, so this discussion, we're going to talk about market structure basics. And the reason I want to talk about market structure is because I think some of us, if not all of us, have started with indicators of some sort. Um, before having an understanding of why we're using the indicators or what the indicators work around. Um, and and it's when you jump into the market, this is just my opinion. Feel free to jump in. Anyone, if you have a question, feel free to post it in the chat um, until the presentation part is finished, and then I'll open it up for questions. Um, but when we jump into the market as newbies, there tends to be a culture of hype where we're not given a really realistic view of what learning to trade is really like. We are given promises of easy money, easy trading. You'll earn six figures in 3 months. None of that is really true at all. But we buy into the hype because, um, we want better. We want to do better for ourselves and for our families. Um, so we have good intentions, but the information we're given is false. Well, like everything in life, um, you have to have a good foundation, or everything you build on top of that crumbles. And that for trading, I think an understanding of market structure is that foundation. So I'm just going to go into what I've learned um, with the caveat of just saying I don't really feel like I've mastered this by any means. I'm still kind of a noob. But I want to share with you what I've learned because this is what I really wish I knew beforehand. Um, and so to start with um, on market structure, uh, the agenda. We're going to talk about market phases, which is how the market works cyclically, like what it does over and over and over again. We're going to talk about how support and resistance zones develop, like what's happening behind the candles moving up and down. That's kind of important. We're going to talk about how to identify really powerful support and resistance areas. I know I wanted to cover trading strategies a little bit right now, but I think because it's kind of a big topic, so I want to make sure we cover the market structure and the supply and demand areas first. And then maybe next week we'll go in depth into the trading strategies. We'll cover it just a little bit here, you'll see. So market phases. Um, the market moves cyclically, meaning it does the same thing over and over and over again. In various forms. There are variations of this up and down pattern. There's flat areas. There's what we call uh, accumulation, distribution, and things of that nature. And the way that looks is this is just a real basic example of it. Um, so the flat area, this area here, where you see that is typically an accumulation zone. Um, and then in an upward trend, you'll see a markup zone. It's more complicated, but you'll see a markup zone. And then there is a distribution zone, which is a flattening out again. And then you'll see what's a decline or a markdown. And then it starts all over again. That's the basics of market phases. So it like I said, it can get really complicated. This is my very basic diagram of market phases. The reason why market phases are important, you have to have this picture of how the market works in your mind because you want to know where you are when you're trading. Um, if you're in an upward trend or a markup zone, you don't want to be looking for a reversal because that's not going to happen. You're setting yourself up to have your take profit hit because you're looking in the wrong direction. If you're in a markup phase, the market is trending upward. Similarly, with a decline or a markdown phase, and you want to stay out of these accumulation zones. And we'll talk about why those zones are forming for accumulation and distribution, and why we don't want to be in those areas until we see signs of a clear direction. So this is simple. This is the simple way to look at it, and this is the complicated way to look at it. Um, when you're looking at market phases or trying to identify them on your chart, uh, it, it certainly doesn't look like that nice clean picture we saw before. You'll see lots of ups and downs and peaks and valleys, but here, see this accumulation zone, it's kind of flat. It's not necessarily completely flat. It could be going up a little or down a little, but it's still an accumulation zone. And those are, you can recognize them by the fact that it's just ranging. It's just up and down within a confined zone. Um, and then for the markup, there's a clear upward trend. And then in the distribution, you'll see it flatten out a little bit or start ranging again. And then in the decline, you'll see a clear downward, a downward trend until that whole phase, that whole thing starts all over again. So what does that look like on a chart, on a regular chart? So let's look at gold. Um, and I'm just going to let that rest for a second so you can see. Do you see, just from looking at it, do you see like a accumulation and distribution, markup and markdown or decline phases? I'll show you where I see them. I see that as accumulation. And here's how it gets a little bit messier or less complicated than that clean picture we showed you. So there's clear markup. We can all see that. And then there's reaccumulation because this is an upward trend. Then more markup, then distribution, and then we go into the decline phase. It's not all clean and pretty like we want it to be, but the phases are definitely there. All right. So for this part, are there any questions? Can you guys, if you have any questions right now, can you take yourselves off mute and ask those questions if you have them, please? Okay, I'm going to continue. Um, so there's a reason why candles move the way they move. It's not random. It doesn't, it's not a throw of the dice. The candles move up and down because buying and selling is taking place. And rather than me try to explain how that whole process works, I'm going to show you just about 7 or 8 minutes from a really good video that explains it all. Give me just a second to get to the right place here. Supply and demand. You will be able to trade with the large institution. Let's see, 45. Somebody please say something in the chat if when I let this go, you're not seeing it or if it's choppy.
find the truth. Now, as history has repeatedly shown, traders are often a very emotionally charged group. When millions of them get together in a highly emotional money game of fear, greed, and uncertainty, their combined behavior takes on a herd mentality. Well, we can spot this on our price charts and make money from it. How? Well, you've got millions of market participants putting millions of orders through the market for a million different reasons. All of this behavior and participation is what drives the order flow that is put through the market. And that order flow is what prints price action on our charts, and that price action creates patterns. These patterns repeat themselves over and over, time and time again. And that allows us to make high probability forecasts of where price may move in the future. Because when those big institutions enter trades, they cannot hide their order flow. Well, we can spot their footprints in the market if you know what to look for. Let me explain. Currency exchange rates move up and down as a result of supply and demand from market speculators. No trades can take place unless both the buyer and the seller agree on a price. So this drives the price of currency pairs, where buyers bring with them demand for the pair, applying that upward pressure on prices, while sellers bring supply, applying downward pressure on prices. The market runs like a continuous auction throughout the day, with buyers and sellers competing with each other to get the best possible price. Now, in a perfect and free market, this would be quite a smooth and fair process, but in the financial markets, this is often a heavy manipulated process. Let me explain. Markets work in two-way auctions. Both buy and sell sides of liquid instruments will have blocks of orders on both the bid and the offers. We can see this visualized on the order. On the left-hand side, you can see all of the bids from the buyers. And on the right-hand side, you can see all of the offers from the sellers, as this is also called the ask price. And this shows how much volume is supplied at each price level. And the more volume that there is at each price level, the more liquid the market is. Think of it like an auction house or eBay, where if you are the buyer, then you are making bids for it, and you are the seller, it's the price you're offering it, or the price you're asking for someone to pay for it. Now remember, the trade can only take place if both the buyer and the seller agree on a price. So to execute an order, it must be paired with an opposite order of equal size. For example, to sell 10 lots, there must be a buyer willing to buy them at the ask price and vice versa. This is how the markets move. Now, what most people don't know is that there are two types of orders where both buyers and sellers can be passive or aggressive. Passive traders use limit orders, and they are waiting for price to hit them. So all of these orders that you see on the bid and the ask, they are limit orders. So if there were only passive orders, then the market wouldn't move because all of those orders are waiting to be hit. So this is where aggressive orders come into play. Aggressive buyers and sellers, they are trading at the current market price, and they are not waiting for the market to come to that. But to do that, they have to cross the spread to buy at the ask price or cross the spread to sell at the bid price. Most execution platforms look like this, where you buy on the right-hand side, as that is the current ask price. You must cross that spread to be an aggressive buyer. And if you want to sell, then you must cross the spread to the left to hit the bid. And it's this interplay between passive and aggressive orders is what we call order flow. So let's take a look at a very oversimplified example of what can happen on the order book in a live market. Imagine this was the order book for Euro-Dollar, and a large institution wants to buy 10,000 lots on its market. So this is an aggressive order. They have to buy 10,000 lots at the best ask price. As you can see, there are only 103 lots available for sale at that current ask price. So the price will rapidly shoot up as it instantly absorbs all of the supply at each level until all 10,000 lots have been filled at 1.1539, due to that huge imbalance between supply and demand. And now the market is sitting at what is deemed to be fair value between buyers and sellers. So price has to keep moving up to search for enough liquidity to fill the order. Institutions cannot hide those huge imbalances that they cause in the market. So if you know how to spot their footprints on a chart, then you can trade with their order flow rather than getting smashed against it. So what does this look like on a candlestick chart? Here you can see price impulsively moving to the upside as aggressive buyers keep pushing price higher and higher until they find enough supply to fill their demand, and price is then rebalanced. Likewise, here you can see aggressive sellers liquidating all of these bids, pushing the price lower and lower until they have consumed enough demand to fill their supply. And this is how markets move. When there is an overwhelming imbalance between supply and demand, price will keep moving to search for new liquidity to rebalance price. And this is happening every single second that the markets are open. Now, obviously, you and me, we're not quite trading at the size big enough yet to move those big liquid markets. So how do we make sure that we are trading on the right side of that institutional order flow? And that's where supply and demand zones come into play. How do we identify these zones? When price is moving sideways in a range, this is where orders are being accumulated or distributed. As price moves into the bottom half of the range, this is where buyers step in to buy at discount cheap prices. And then as price moves into the top half of the range, sellers step in to short at premium expensive prices. You want to buy low and sell high, right? It's pretty simple. Eventually, aggressive buyers will cause an overwhelming imbalance between supply and demand. And this is where price will rapidly break out of the range to the upside to search for more liquidity to absorb the demand. And this is what creates those demand zones. Now, we don't trade the initial breakout, as this is where losing traders FOMO into long positions and they buy the highs. Instead, we wait for price to return to that zone, and then we look for our entry models to get long, as this is where the risk reward will be on our side when we are buying where the institutions will be. Now, why does price return to the zone and then continue from there? Well, at this level, there is not enough demand to keep pushing price higher. So we wait for price to return to the demand zone where those previous institutional buyers, they will have a vested interest to make sure that price does not trade any lower, and they keep their initial long positions in profit. And it's also likely that they did not get filled on all of their original position, so they will want to get long with their remaining orders at these discounted prices. Because remember, they're going to want to buy as cheaply as possible. Now, there are some other theories, but we won't get into those in this video. And the exact opposite happens in the creation of supply zones, where price is in a range, sellers will then cause an overwhelming imbalance between supply and demand. This price will rapidly break out to the downside. But again, we will wait for price to fall back to that supply zone to then look for potential shorting opportunities. And it's a four-step process where we have the range, the initiation, the mitigation, and the continuation. And it's that continuation is what we are looking to trade in line with the institutional order flow. This is the cycle and heartbeat of the market, where order flow will continue in one direction until there is an overwhelming imbalance between supply and demand in the opposite direction. Price is constantly seeking liquidity to rebalance price. So here you can see price rapidly initiates out of the range to the downside, creating a supply zone. It's likely this was backed by institutional involvement. Price then pulls back to mitigate the supply zone, where we can look to get short to catch the continuation. You can see the sustained bearish order flow as supply is clearly in control. But markets obviously don't move in one direction forever. Eventually, the market moves low enough to discount prices, where demand then comes into the market to overpower supply. Then we see the sustained bullish order flow. Institutions will defend the last levels that they entered at to keep their running positions in profit. The highest probability trades will always be in line with order flow, so just don't bother trying to fight it. So how do we mechanically draw supply and demand?
Okay, good stuff, right? Was that a lot?
Interesting. Yeah, it's understandable.
Yeah, that's what's happening behind the scenes. And so when we understand how the market works and what's moving the candles, we can be in position to jump into a trade at the right moment and in the right direction. I'm going to show you. So this brings up, let me get back to my presentation here. This brings up the question of how we how we draw supply and demand zones. And most of the time, supply and demand zones, there's several different ways to draw supply and demand zones. And I struggled with this because I wanted it to be perfect. I wanted to make sure I really understood exactly where I'm supposed to be drawing the zones. But it turns out the reason I was confused is that there are several different ways to draw supply and demand zones, and there are different types of zones by definition. For example, supply and demand is different from support and resistance, and so on and so forth. It's kind of a technical thing, but not really, because supply and demand is a more precise zone. That's the best way I can put it. It's more precise. So let me show you what I mean by drawing from a base candle. In this example, I'm not sure if you can see it really good, but in this example, you'll see a drop, a bit of a base, and then a drop. Okay, a drop, base, drop. The base in this case is one candle, and that's can't remember what that's called, gravestone doji. I can't recall what exactly that candle is, but it's indicative of on a lower time frame you would see a bunch of smaller candles here, but this is probably drawn on a 4-hour or 1-day chart. But for this supply zone that is drawn, all that's happening is a box is drawn from the top of that candle's wick to the bottom of that candle, including the wick, and then it extends further along into the time. Again, this is how supply and demand zones are drawn, and not exactly the same as support and resistance, but that's I don't want to get into that too deeply because of my own confusion about it. So let's look at how to draw your own trading zones in TradingView. Again, I struggled with this, so I'm going to show you how I cheat to draw my zones. I'm going to make this available. I'm going to make this whole presentation available so that you guys have it in recording and the resources that are linked to it, just so you know. This will be available as soon as I have a chance to set it up when we're done. All right, let me get to my TradingView chart. All right, this is NAS. This is NAS yesterday. The concept is the same for everything. But I like NAS, so I study and work and play with NAS. I recommend you do the same. Find one pair or one indice and study the living daylights out of it. Know everything there is to know about that one thing before attempting to analyze other pairs. Just a solid recommendation for moving forward without getting stuck. Pick one thing and get good at it. Back test it, forward test it, use it in your demos. Know everything there is to know about your special pair. I'll stop my rant and show you. All right, so seasoned traders can look at this thing and automatically see the zones. Wait, are you guys seeing my chart? Yeah, I think so.
Yes, yes.
Okay, thank you, Sophie. Seasoned traders can look at this and automatically see the zones. I, on the other hand, still am not certain that I'm drawing my zones correctly. My coach showed me this trick that works like a charm until I'm a big girl and know how to do this the right way, until it just pops out at me like the experts. So in TradingView, and TradingView is free, FYI. There's no cost for TradingView unless you want the one with more bells and whistles and you want to look at more charts at one time. I use a paid version because I like multi-time frame analysis. I want to look at several different charts at one time and see them all, like on the 1 hour, the 30-minute, and the 15-minute. You can't do that on the free version, so I do pay a little to get all the bells and whistles, and I can save different charts and stuff like that, but the free version does just fine. All right, so the cheat code is to change from a candle chart to a line chart, okay? Then draw your zones around the peaks. So I see peaks here. I'm going to grab them from the top to the bottom. And those guys right there. Drag that out a little bit. And then I see another one here. Oh yeah, that's a good one. Oops, let go. Let me see one here. I kind of want to grab this one too, just because it's a peak. Yeah, I do want that. And I'll grab this one. And so on and so forth. You can go further down. As a matter of fact, I think I will grab this one here. Just so I can show you that these can be labeled. You can, when you double click, you get this option for text. And I'm going to just label this H4. And you'll see that it, let me make the text a little bit darker so you can see it. You see right here the text. And you can have templates so that you don't have to redraw everything all the time and relabel everything all the time. They're templates and they make this whole process a little easier and faster. All right, so now let's turn the candles back on and see what we have. Boom. I like it. Captured this down, this one. I'm not sure about this. I'm going to keep it though. This one perfectly. I like this. So what I see here, especially here, I'm going to draw it out. See a sharp upward move here. It's probably breaking out of a consolidation zone, excuse me. Just trying to make my line darker, excuse me. So I see this breakout here, where it comes all the way here into this zone, and then retraces back down into the zone for continuation up to a higher high, back down and up to another higher high, and oh, lost me, and down to a higher low, and up to a higher high. Right? Is everybody following? Yeah? We're going to assume silence means yes. Questions in the chat if anything needs to be explained. All right, so in this instance, we can see the continuation here, which would be an entry opportunity on the right candle formation. So in this case, if obviously you don't want to trade indices on the 4 hour, but this gives you a, a, a larger picture view of what direction the market is moving in. And that's really what we want in the beginning, is just to know, am I headed in the right direction? If you're headed in the right direction, you're less likely to be trading against the trend. When you trade on lower time frames only, without ever consulting the bigger picture on the larger time frames, you set yourself up for failure because your view is too small. I hope if you get nothing else from this, you understand that looking at the bigger picture is important before you begin your trading day. Always start your trading day by analysis of the higher time frames before jumping in on the lower time frames. All right, now I'm going to stop here the recording and open up for questions. Just a moment.